Hi, and welcome to the Day Trading for Beginners podcast. This is episode 12. And in this episode, we are talking about Forex. So we're going to talk about Forex trading for beginners. This is going to be a very beginner friendly podcast, sort of like an introduction to the Forex market. Now, my name is Tyler Stokes from StokesTrades.com. I'm on a mission to become a full-time day trader, and we are sort of ending the first phase of this journey where we have sort of reviewed a lot of stock market basics. So we talked about stocks, we talked about bonds, ETFs, then we talked about, commodities in the futures market, and we talked about options and short selling. And then now we're sort of wrapping it up with the Forex market. And these are sort of the things that you can day trade. So in the next podcast, we're sort of going to do a recap, and then talk about the decision that you're going to have to make, deciding on what market you maybe want to start trading in. And then we're going to open a brokerage account and then continue on with this journey. So if you ever want a blueprint of the steps that I'm taking for the first 6 months, you can download that in the show notes, or you can go to stokestrades.com/blueprint, where you can download and get an update of this journey that we are on. So let's jump right into it and talk about Forex for beginners. So what we're going to talk about here is we're going to talk about, what Forex actually is and how the trading works for this market. And then I want to talk about leverage and then some of the reasons why this is very popular for beginner day traders. So that's sort of like the agenda for this podcast. So like many of the other podcasts we've done, I've sort of gone and asked the AI tool from X called Grok to sort of give us a fun definition of some of these instruments. And then we can kind of read through that and then go on to further deeper dives into the actual components. So here's what Grok has sort of told us about Forex. Forex, or FX, is short for the foreign exchange market. So it's a global marketplace where currencies are traded. It's like a massive international game of Monopoly where the currencies are the properties and the players are trying to make the most profit. Now, the market is open 24 hours a day, 5 days a week, and it is the largest financial market in the world with an estimated daily trading volume of more than $6.5 trillion. Now, Forex trading is like playing a game of poker with the world economy. You're trying to predict which currencies will go up in value and which will go down, and then you make your bets accordingly. So it's a high stakes game, but the rewards can be great if you know what you're doing. But, how do you know which way the currency winds will blow? Enter the fun and mysterious world of fundamental and technical analysis. Fundamental analysis is like being a detective digging into a country's economic and political news to uncover clues about its currency future. Technical analysis, on the other hand, is like being a fortune teller using charts and patterns to predict the future movements of currency pairs. Forex trading is an exciting and potentially lucrative way to make money, but it's also a risky game that requires skill and knowledge. So if you're ready to take the plunge, put on your poker face and get ready to play the game. So there's a sort of fun description of what the Forex market is. So basically, Forex, it's a worldwide financial market where individuals can trade currency. So you're buying and selling, another country's money, so to speak. So, how does this really work? Well, the market is decentralized. And when you say that, and when you hear that, or when I heard that, I sort of needed to get a little bit better of an explanation of what that means. There's a lot of jargon in the finance world. Sometimes you're going to run up against it, and you just need to sort of do a Google search and just get an understanding of what some of these definitions are. And you'll understand that, they're relatively easy to understand, but some of the words sort of sound a little bit intimidating or, confusing, like derivatives or arbitrage or things like that. So decentralized, well, what does that really mean? Well, imagine a big school playground where kids trade stickers with each other. There's no single place or special teacher controlling, where and when these trades happen. Instead, kids trade stickers directly with each other all over the playground, wherever they want. There's no central sort of authority making rules for how these kids trade these stickers. Well, the Forex market, it's like that playground. It's decentralized, which means, there's no single location or like central exchange where all currency trades happen. Instead, currency trading, it's done electronically over the counter, OTC, which means all transactions occur via, computer networks among traders around the world rather than through one centralized exchange. So banks, financial institutions, corporations, governments, and individual traders like us, we can exchange currencies with each other directly, no matter where we are in the world. And this decentralized nature allows Forex market to be operating, 24 hours a day, 5 days a week. Now, obviously, you're going to do this through some sort of broker, but you can see that there's not sort of one hub for these trades to happen. So, just like the kids trading stickers with each other whenever they want, traders in the Forex market can trade currencies at any time during the trading week from anywhere in the world. There's always someone to trade with, just like there's another kid who's going to want to trade stickers on the playground. So that's sort of decentralized, and hopefully that's a little bit of a better understanding of how it works. Now, there's another sort of example we can kind of go through, which will allow you to understand how a Forex transaction works, because you've probably done this before. I know I have, and many people have. Even when you're purchasing things, you sort of go through this. But, imagine you're planning a trip across the border from USA to Canada. Before you go, obviously you realize you need some Canadian dollars to spend while you're there in Canada. So you take some of your US dollars and you want to swap it for Canadian dollars. So, you walk up to a money exchange, which are located at airports, but there's, currency exchange businesses maybe in your city as well. And you see a board showing the different money values and the different exchange rates. And, you find the Canadian dollar listed, and it might say, $1 US gets you 1.3 Canadian dollars. And you think, cool, that's, my money making more money for me. So you exchange, $1,000 for your trip, and you're going to get 1,300 Canadian dollars back. So without knowing it, or with knowing it, you've just taken part in the Forex market by swapping, one kind of money for another. You sold your US dollars and you bought Canadian dollars. So 1,000 US dollars got you 1,300 Canadian dollars. Now, when your trip's over, you might have some Canadian dollars left, and obviously you want to change them back when you go back home. And now you notice that the exchange rate has changed. So $1 US maybe now gives you 1.2 Canadian dollars instead of 1.3. So the numbers moved a little bit. And if the exchange rate went from $1 US equals 1.3 Canadian dollars to $1 US now equals 1.2 Canadian dollars, the purchasing power of the United States dollar, US dollar, in terms of Canadian dollars, it's gone down, indicating, a weakening US dollar. So before, your $1 US got you 1.3 Canadian dollars. Now your $1 US is only getting you 1.2 Canadian dollars. So its purchasing power relative to the Canadian dollar has gone down. So when you change back your Canadian dollars, you're going to notice that you might get a little bit more. Now, instead of $1 Canadian giving you, 75 cents as it would with the original exchange rate, now you get, 80 cents for that dollar. So sometimes when you talk about those, or you're listening to that, you might need to write it out and do that fraction, a little bit of simple math. Can get a little bit confusing, but there, $1 US went down from 1.3 Canadian to 1.2. So in terms of the Canadian dollar, the US dollar has lost a little bit of purchasing power. And when you exchange your Canadian dollars back to US, you're going to get a little bit more US dollars. So this change in money value, that is what traders in the Forex market try to make money from. And in order to do that and trade on the FX market, they're going to be trading in currency pairs. So just like that sort of US Canadian one, the Forex market is made up of these currency pairs, which sort of represents the exchange rate between the two currencies. So we're going to run through an example. In the show notes, there's going to be a link to a YouTube video of this discussion, and that might help you. You can also access the full article if you need to kind of read through this a few times. But when these currency pairs are listed, you might see them, or they'd be listed as Euro/USD. So if you're going to trade this currency pair, the euro and the United States dollar, then it would be listed as EUR, so Euro/USD, the United States dollar. And the first currency listed in a set of pairs is called the base currency, and the second currency is called the quote currency. Now, when I was looking at this, I was wondering, can it also be listed the other way around, USD/euro? Well, the way that these currency pairs are listed is sort of like a specific way. So the Euro USD, that's a common, widely traded currency pair. But, if you were to flip that USD Euro, that is not, conventionally traded. So traders in financial markets, what you would need to do is you would just sort of inverse that if you wanted to understand what one USD gave you in terms of euro. So that wouldn't be a standard convention in the Forex market. So we're not going to talk about all the different currency pairs here, but basically they'll all be written in a specific way. And that's sort of how they are quoted. Some countries will be the base and some will be the quote. And that's just sort of how they are read. I'm not going to go through all the currency pairs here, but what you could know, which is sort of a general point, is that the currency pairs that have USD in them are generally traded the most. So you're going to have, the British pound against the USD. You're going to have the euro against the USD. That's one of the most popular. You'll have the Canadian dollar and the USD, and so on. So the way they are listed is sort of the conventional way that they are listed. So, how these actually work. Again, the base and the quote currency. So the first listing is going to be the base, and then the second listing is going to be the quote. So if, for example, the euro against the USD, if EUR/USD is trading at 1.2, what that means is that 1 euro is equivalent to 1.2 US dollars. And then, if you wanted to see what US dollars were worth in terms of euro, then you'd have to just sort of manually do a little fraction there. So when you're, buying and selling and trading in the Forex market, you will trade a currency pair. So you buy one currency while simultaneously selling the other one. So if you buy EUR/USD, the euro against the USD, you're essentially buying euros and selling US dollars, just like we kind of talked about in that example. When you're going over the border, you're going to sell your United States dollar and buy Canadian dollars sort of at the same time. That's what goes on here when you are buying and selling these pairs. So this concept of sort of buying and selling at the same time might seem a little bit confusing, but in essence, when you buy a currency pair, you're buying the first one, which is the base currency, and then you're selling the equivalent amount in the second, the quote currency. So if you were to sell the pair, you'd be doing the opposite. You'd be selling the base, and then you're buying the quote. So when you sort of go through examples, whether you read through this article that's in the show notes or watch the video, it should be a little bit more clear. But the profit or loss from your trade, it's going to depend on the movement of the exchange rate between the two currencies from the point where you entered the trade to where you exit it. So whether you're buying or selling a pair, you're always engaging in two actions at once due to the nature of these currencies being traded in pairs. So I'm going to go through an example here, and hopefully it gets a little bit more clear. So your step one, if you were to kind of like go through a real example here, what you're going to first do is you're going to choose, a currency pair to trade. So let's pretend we decide to trade one of the most popular ones, the Euro USD pair. So the Euro is the base and the USD is the quote. And the current exchange rate, we're going to pretend it's 1.2. Again, this means that 1 euro equals 1.2 US dollars. So after, conducting your research, your analysis, whether that's technical analysis or, some fundamental issues going on in the world, you believe that the euro will strengthen against the US dollar. This belief leads you to buy this pair. So you want to buy the Euro USD pair. So you enter a buy order for this pair and the exchange rate of 1.2. So what happens is you are buying euros and you're selling the equivalent amount of US dollars. So let's say you buy 1,000 euros. That's going to cost you 1,200 US dollars. Now, suppose your analysis, it's correct. The exchange rate for Euro USD increases to maybe 1.21 due to whatever reasons. The euro is strengthening against the dollar. Now you decide to sell. So you want to close out your position and your 1,000 euros, they're now worth 1,210 US dollars. So you profited in this trade by $10. The exchange rate went up in your favor and you sell the euros and you buy back the US dollars and you receive $10 more than you did when you initiated the trade. So that's just a very sort of simple way of how a trade works with these currency pairs. So, when you bought that, you were expecting the value of the euro to go up relative to the US dollar. And then when you sold it back at a higher rate, you're exchanging the euros back for US dollars. And then that profit or loss comes from the exchange rate movement, when you entered the trade. So when you bought the pair and then when you sold the pair. So your aim is really to predict the direction in which the exchange rate between two currencies will move and then trade accordingly. Now you might think, oh, I made $10 there. Well, there's this concept of leverage with this market that's very important because some of the ways that Forex is traded, it's traded in what's called lots. And we're not going to get into that in this discussion, but there are some technical differences and things to learn in terms of buying and selling in this market, which is quite different from just buying a stock. But we will talk about leverage here because what it does, it's going to increase your buying power, allowing you to control a larger position with a small amount of money. And that's what's kind of popular about the Forex market, but certainly it's a double-edged sword. So let's run through an example where we're looking at leverage of 1 to 100. And again, this is just for example purposes, but the way it works is you can certainly, double your money, but there are a lot of risks on the downside as well. So let's talk about this leverage ratio. We'll talk about it as 1 to 100. And then we'll just pretend your capital, your initial investment is going to be just $1,000. So if you use leverage of 1 to 100, what this means is that every $1 of your own capital, you can control $100 in the Forex market. So your $1,000 can control a position worth $100,000. So there's going to be, two ways that your trade could go. Either it's going to be profitable or it's not. So let's look at this first scenario. Suppose you use your 1,000 to control a 100,000 position, and the currency pair you're trading moves by 1%. So this movement on a 100,000 position equals $1,000 gain. So with no leverage, a 1% move on your 1,000 investment, it's going to make you $10. With a 1 to 100 leverage, the same 1% has moved and your gain is $1,000, effectively doubling your investment. But if the market moves 1% against you, you would lose your entire $1,000 initial investment, which would wipe out your account, so to speak. So without leverage, a 1% move against you would just result in a $10 loss, and you're sort of still in the game. But if you have leverage and it goes down by 1%, it wipes out your total account. So that's sort of an extreme example with just a small account of $1,000 using a large amount of leverage. But there are some key points just to note from this basic example. Leverage is going to amplify your profits, but also your losses. So it can significantly increase how much you make. But on the flip side, if it goes against you, it could wipe you out. And then there's things called margin calls where, if your losses are approaching your initial deposit, so if your losses are getting close to your $1,000 there, the broker may issue a margin call requiring you to deposit more funds. Now, in this example, you would probably be using a broker where you might be able to set up an agreement where you can't have a negative balance. And basically, if the market moved 1,000 or 1% against you, your account is just going to be wiped out. You're not going to have any negative balance. But there are cases where, if it keeps going by you and you can't meet these margin calls, you can't deposit any more funds, or you don't close out your position and you don't have an agreement that you can't go negative. There are certain cases where, you might have a negative balance. You might owe your broker money. So you certainly don't want to get involved with that. But, for margin calls in general, sometimes if, you have more funds in your account, you might be asked to, make more deposits to kind of get your balance back on par. Or, you might be told, hey, you're approaching, losing all your money in your account. Either add more or we're going to close out this account. So in this example, you can see how 1% move against you, you're wiped out. You certainly would not want to do that, but you can start with leverage with different amounts. You can start at a leverage position of maybe 50 to 1, so it's less, or even, you can trade in the Forex market with much smaller amounts, like a micro account, meaning you're not risking as much, and you can start leverage positions, maybe even 10 to 1 instead at the beginning. And certainly, as beginner traders, we certainly only want to trade paper accounts until we get a strategy that works. But, leverage is important to discuss in the Forex market because that is certainly a tool that many people use. And that's one of the reasons why it is very popular for beginners. There's low entry to enter this market compared to some other ones. Starting trading Forex, you can do so with a relatively small amount of capital, and you can use that leverage that we talked about. Many brokers, again, they offer this micro or mini accounts, which allow traders to start trading with really low amounts of initial investments. And you sort of can't always do that when you're investing in other types of securities like stocks and whatnot. So this accessibility makes the Forex market attractive to individuals who might not have substantial capital to start trading right away. Now, the other reason which is going to be attractive for many people, especially us beginners, if you're doing this, you have a job right now and you're sort of learning as a side hustle, maybe at night you're studying or doing things on the weekend. That's certainly what I'm doing right now. The 24-hour market can be attractive for people like us who are beginners. It's open 24 hours a day, 5 days a week. So this flexibility, it's going to allow traders to engage in trading when their other commitments are put on hold. So whether you're, raising kids or family, I personally have a young little guy that I'm looking after right now. So for me, I'm not going to start trading till, in the future. But if I were to want to trade right now, I couldn't do that when the stock market opens at, 9:30 Eastern time. I would maybe want to look into this market. So it's certainly a reason why it is popular. Then lastly, there's this idea of liquidity, and I'll just talk about it briefly here because sometimes, if you're a beginner and you hear the word liquidity, you might not really know exactly what it means. But in terms of the Forex market, because it's such a large market, it's the biggest financial market in the world. It has high liquidity, which means that, large trades can be executed quickly with minimal sort of price slippage. And this is an advantage for day traders where speed and price efficiency are crucial. So, there's this notion of, the bid and ask price. Well, sometimes if you're trading and you want to buy and sell within the same day or relatively quickly, with high liquidity markets, the bid and ask price, the difference there is going to be small. So, if you buy, say at 100, but when you turn around, you want to sell it in a low liquidity environment, you might only be able to sell it for maybe $102. So you're going to lose that difference there. And that's referred to like as the cost of trading. But with Forex, the cost of trading is low because there's always going to be buyers and sellers. So if you sort of imagined, you're at this huge bustling market where lots of people are buying and selling fruits every second. Because there are many, many buyers and many sellers, you can easily, buy a bunch of apples or sell your oranges. Well, the Forex market, it's sort of like this fruit market, but for the currencies, high liquidity, what it means is there's always lots of buyers and lots of sellers. So you can quickly and easily trade your currencies without a big difference in price for when you decide to actually make your trade. And again, this makes it easy to exit and enter trades, and then it reduces that cost that's associated with the difference between what you buy and what you sell. So that's an advantage as well, especially if you are doing day trading. And that is certainly what we're talking about on this journey. So I think we'll stop there. I think that's a good introduction to the Forex market. Things that we didn't touch on were the way these are traded. That is certainly another discussion that we might have in the future, the way you buy and sell and the different, it's called pips and lots and whatnot. So it's a little bit more of a technical discussion that I think we'll hold off into the future. But I think that was a good sort of beginner introduction to the Forex market. And again, there's a lot of reasons why beginners might want to get into this market. And hopefully, this has helped you decide if you want to kind of look into this market a little bit further. So thanks so much for listening. Subscribe to the podcast. Again, in the show notes, you can download the blueprint that I'm on, and I will update that with how this journey is progressing. You can find a link to the YouTube channel as well. So we'll have YouTube tutorials that sort of go through some of the things we discussed on the podcast in a little bit more detail, sort of on a whiteboard, so to speak. And then this is going to wrap up this first phase of this journey. We've done a review of everything, and now we're going to get into the next phase where we're going to open an account and then study a specific strategy eventually with some of these trading environments that we can trade in. So look forward to the next podcast. We're going to talk about a mindset, and we'll do a recap, and then we're going to jump in and actually take some action and open up a brokerage account. So thanks so much for listening. Subscribe to the podcast, and I will talk to you in the next episode.